Hello, I'm Steve Schomer from Adrenaline Homes in Kenosha, Wisconsin, and we are a retailer of manufactured and modular homes. And we often get the question, where do I go for financing? And so we've assembled a small group of people here from various banks and financing companies to try to answer that question for you. So hopefully we are able to provide some information you may not be aware of and answer any questions you may have. And at a minimum, we'll provide you some resources on how you can get in contact with those individuals that will be following me shortly to potentially begin the process of getting approved for financing. So I would like to just clarify for everyone that we sell three different types of homes. We sell a manufactured home in a single section home that you might find in a mobile home community or in some cases on private land. But there's one part of it when it's on that community or leased land. That's one category of financing you may have to work through. The second one is a manufactured home that's on private land. And for us, a manufactured home usually means that it's on a concrete slab or anchored to the ground in some other way that is not a basement or a crawl space foundation. And that's then the third type of home for us is the modular style home, which is placed upon a basement, full basement or crawl space walls. And so we're going to try to differentiate between those three categories of houses as the discussion goes. And so hopefully you find it interesting and helpful, and we'll go from there.
And we've got all three of you on stage now.
All right, perfect.
Awesome. Who's starting?
Hi. So yes, thanks for having us here today. So let me just introduce myself. My name is Michelle Garibay. I'm a mortgage lender with U.S. Bank, and I've been a mortgage originator for probably 29 years. Yes, long time. We love to, do options for buyers that make it affordable, and these options are definitely some affordable choices. Do you want to introduce yourself as well?
Absolutely. I'm James Bochnovic. I'm with Preferred Rate Mortgage. Got a bunch of different locations. I happen to be out of the Lake Geneva office, though. We're also a mortgage lender, specialize in a lot of different items and a lot of different products, but obviously here today to talk about that affordability option. I know that I've been talking with Adrenaline a bunch in the past, and there seems to be a niche. Right? There's not a lot of homes that are available for that $200,000 or $300,000 range that are new builds. And this is a really good way to fit into that niche. Obviously you can go higher, you can go lower, but those homes that are available right now are in bidding wars. The volume is so low. If you make an offer, there's also 27 other people making an offer, where if you build your own, you're not going to have to compete on price.
Yeah, that's a good point.
Yeah, it's kind of crazy because we'll see what happens, but right now builders aren't incentivized to build those $200,000 or $300,000 starter homes, or even lower or a little bit higher. They're really incentivized to build those $600,000-$700,000 forever homes, and the average first-time home buyer doesn't want to afford it or can't afford it, and they need an outlet. And I think Adrenaline really provides a great outlet for that.
So why don't we're joined by one of our lenders remotely. And so why don't we have Christian introduce himself now?
Hey guys, my name is Christian Blaker. I'm from Cascade Financial Services. We are a lender that specializes in manufactured and modular housing. We do a little bit of site-built lending, but it's very, very few. We were started about 25 years ago for basically exclusively for manufactured housing. I've been in the industry for full-time for about 15 years. I was a loan originator for about 10 of those years. And then now I have more of kind of a regional role.
Okay, so what we want to try to accomplish today is, like, when somebody were to come in, let me give you an example of a buyer possibly that comes in and they're looking for, as I mentioned, a single wide manufactured home that's going to be on a community or leased land. Okay, and so I think, Michelle, you're that one's probably not outside of what you're normally comfortable with doing. And James, do you want to comment on what you're looking for in that area?
Yeah, same kind of thing on me. If it's on leased land, if it's not going to be truly real estate and you won't be the owner, that's more of a, it's not my scope of work. I think I forgot the other person's name. Christian. That might fall in his category.
Yes, we do a ton of home only, or what we call chattel lending. And like he had said at the beginning, it kind of falls into two categories, which is either going to be community or park or private property. So, you're typically going to find that the rates on this are a little bit higher than kind of the rates you see on TV. They're typically going to be somewhere, if all the stars align, you might be somewhere in the 7s, 8s. It can go higher than that depending on credit and down payment and things like that. But there's a lot of upside to those too, in terms of the closing costs, and the fees are much less. The process is much faster and easier. It's really land a lot of times, tying a home to land, that creates a lot of the extra steps in terms of appraisal work and title work and surveys and all this. So there are some positives to doing it. It's a fast and easy and cheap loan. It's just the rates sometimes can be a little bit of an adjustment for new buyers if they're not familiar with this type of lending.
Sure, Kristen, and just sticking with the single wide on a community, can you give us, I know every person, every situation is a little bit different, but can you maybe give us a range of what to expect as far as how long it will take the application process before somebody would find out? And then also similarly on down payments, I don't know if there's a range or it's a set amount, but could you comment a little on the down payment range?
Yeah, absolutely. So the application process is normally pretty quick. Typically within a matter of a day or a couple of days, sometimes depending on how things time out, you guys could have an answer very, very soon. In fact, we have some automation where sometimes we can get answers almost immediately. Now, in terms of the process itself, we can go just about as fast as the information can make its way to us in terms of the documents that are needed. Now, the documents that are needed to get somebody processed on a loan are pretty similar to any type of mortgage, right? We're going to be verifying things like job time and income. There are certain, if somebody's receiving child support, there's always, kind of the standard documents that are going to be required, and we can go as fast as those documents can be received and reviewed by us. So it is not a terribly uncommon thing for us to issue an approval maybe today, and then within as early as 7 to 10 business days, we can sometimes have a closing. Now that's not the normal. We can do it though. It just takes a little bit longer to get the information that we need and the documents that we need. Rarely, sometimes they take longer than 30 days, but a lot of times they can be done within a couple of weeks. But we can move extremely fast as long as we're provided the information that we need. We can go. We prefer to be waiting on you guys than you guys to be waiting on us. So typically, we can get that stuff processed extremely quick.
Appreciate that. And then when there are some cases where we may have a move-in ready home that's available for somebody right away, we do a small percentage while we do it in that range. But there are also other times when they will need to order one from the factory, so to speak, and wait anywhere from 6 to 12 weeks for one to be made. And so during this time, we're trying to figure out when is the right time, I should say, to start the process of financing. Should they get pre-approved if they're looking at a single wide on a manufacturer, or on a community? Is that something they should also do, and when would maybe be my next question?
So generally what I see, and I work with a lot of retailers and have been for a while, and kind of the normal flow is that you want to get pre-qualified before you start placing orders from the factory. That's generally when you saw me a minute ago, kind of in that range of 7 to 10 days to a month. That's kind of typically what's going to be a factor in that range, is how long it takes for the buyer and the builder to kind of iron out the details of ordering the home and what kind of features and options and things like that. But generally, what we see is that somebody comes in, they know that they want to buy. They're not necessarily. Sometimes they have the specific home picked out and know exactly all the details, but sometimes they come in and they're just trying to figure out where to start. And And so either way, the first step is just to apply. You apply, you figure out what your buying power is, you figure out how close the payment range is going to be to kind of what you had wanted. And then typically what I see is the home is not normally ordered until right before closing or maybe right after closing. It's just something that kind of protects all parties from having a home on order that could potentially fall through in any way. So typically what a lot of builders do is they're going to at least get you very close to closing and have a really good idea that everything is going to flow smoothly. But one of the good things about, like with us, is there's about a 6-month window. There's no construction interest, which is really nice on one of these home only loans. But there's about a 6-month window in terms of when the income and things are going to expire. So for us, I mean, obviously most people like to do them very quick, but if you're coming into this process and you don't really have a lot of the specifics nailed down, even in, as long as you have it, you want to have it done obviously before closing. But there is some time there that you have some leeway in terms of, the time it takes to get everything done and for the site prep and the delivery and setup and everything like that.
Yeah, and I'll back that too. It's the same old general thing where whatever you're trying to purchase, whatever you're trying to do, whether it's a house or a car or even you're going to the grocery store, you got to know how much money's in your wallet before you go shopping. And that's kind of the financing piece here, right? Whether you're going to do a chattel home or a traditional, build on land, right? You got to know what you're qualified to purchase. And even more important than what you could buy, what are you comfortable paying every month? Factoring in whether it's, like lot fees or taxes or whatever. You have to be comfortable with what that payment is before you go and get into something, because you could be thinking, hey, this payment's going to be X. Well, then you go fall in love with a house and fall in love with the build and the design and the construction, and then it's double X and you're not expecting that. So I would much rather somebody get pre-approved, have an idea of what it's going to cost to get what they want, and then go into that aspect. Because if it's, hey, I want to put this extra thing on, it's going to be a little bit extra every month. Cool, we can handle that, rather than double the price out of nowhere. Rather go in eyes open.
All right, well, great. Then I guess the next scenario would be a manufactured home, whether it's single or double wide, but going on private property. Mm-hmm. And now some of that's going to require some contracting or some building, if you will. And that's going to extend the timeline, but it also complicates the loan from being a home only loan, right? So I wanted to see, let's just say you had a double wide on private land, they already own the land. Maybe James, this question to you first. What does the potential buyer of a home need to know about how the construction process works? Maybe contrast that to a traditional site-built home, if you think that's important. Yeah,
no, of course. It's honestly, it can be very similar to a traditional site-built home. It's just the construction process in its own right? We have a couple different products. So again, getting pre-approved is super important so we can know exactly what your budget looks like and what type of product you could qualify for. We have one-time closing, two-time closings. We can do FHAs, VAs, conventional loans, of course, we do conventional loans, but it's really just what does your situation look like? And then we can guide you on how the process works or how it could look. You don't even have to own the specific lot yet. That can be included in the construction process and what we fund on the construction side of things. So, getting pre-approved, knowing what your options are really opens up, I guess, your options, without saying any more. But, you could say, hey, I like this lot and I like this home. I want to build this home on that lot. All right, cool. Let's get you pre-approved. We can close one time and then your construction starts. And as soon as it's done, you move in. And that's pretty much it. You can do a two-time close on that, where you close on a construction loan and then you close on your long-term financing. There's a lot of different options and ways to structure that. And one thing I mention a lot to people is, hey, if you see something on TikTok or Facebook and you're like, I'm going to do it that way. Well, obviously you agree, right? Financing isn't one size fits all. Everybody has a unique situation. Every property is a unique situation. Even if it's just the the home itself, a home only loan, it's a unique situation every single time, right? So take advice from people who do this all the time, us three essentially, and say, hey, here's how you should structure this. Here's how you should go about this. You could go this way or that way, but here's our suggestion and here's why. You know what I mean? It's, again, there's so many different ways to do it. You know what I mean?
Right. And I guess that's part of it, was to introduce the potential client to names and faces and say, hey, I want to be comfortable calling and asking questions and help somebody choose, because I don't know. And then that was also, and Michelle, maybe you could answer this question too, because James had mentioned FHA and the different programs like that. I could just feel myself a little bit going, I don't know if I should ask about those. I don't know what those are for. So maybe if you could share a little bit what the person needs to know on the front end, or just simply give you a call and then you tell them.
Yeah, you bet. So to back up a little bit, to talk about the difference kind of in when you're building a house, essentially, the process is a little bit different than if you're going to go purchase a home that's already built. The way that it works is you can own the lot. You don't have to own the lot, but let's say that you have a vacant piece of land and you're going to build on it, right? During that construction period, well, the first step I should say is you get approved for your loan, right? And then what happens is while your home is being built, the builder is going to do draws, right? So they're going to say, all right, now the foundation's in. We're going to draw this from your line of credit. Now the walls are up. We're going to draw this from your line of credit, right? Whatever that builder has drawn from the line of credit, you as the owner are going to pay an interest-only payment while your house is being built, okay? Now, let's say the home is built, everything's done. Now that loan automatically converts to your permanent loan, which typically it's like a 30-year fixed. It could be an adjustable rate, but typically it's a 30-year loan, right? So then when you're able to move into the property, you start paying that principal plus the interest, and you're in your final loan, right? So that's a little bit different than just purchasing and then your loan already starts. There's a few extra steps involved, like we have to approve the builder. So it's really important. And this is one thing that surprises people. I think people kind of underestimate maybe how much it's going to cost to build something. So make sure, before you start everything, before you purchase a lot, because you want to make sure that you're comfortable with that final payment, decide who you're going to work with, get a builder, know what your costs are going to be, know what that potential payment's going to be, because that's important. How much is this going to cost me, and how much am I going to be paying every month?
Yeah.
So
as far as everything goes, that's the most important thing. You got to be comfortable with whatever that payment is. There's a lot of clients that I'll talk to, and they're just buying a standard, already existing house, or they're building a new one. Here's what the payment's going to look like. Yes, you can qualify for this, but house poor is a thing. And if you buy this house, you will be house poor. Are you ready for that? And, just having those real conversations, and mainly with a consumer facing, having those conversations with yourself. Like, are you okay having this monthly payment be this? Because even if we can legally say yes, we can't say no if we can approve you, just because we got a bad feeling about it. But you got to be comfortable with that first and foremost, So yeah, that's the scariest thing sometimes.
There's a couple of things that we don't look at that are real costs. Is sometimes you might be paying for daycare, right? You might be have a big grocery bill, and those are certain things that we don't take into consideration when we approve somebody for a loan. So you have to know your own budget and what you're comfortable paying every month.
Yeah, and I think I speak for all of the lenders on the panel right now. Call us, talk to us. We would rather you call us and talk to us about this than be over your head or flustered or, in a bad spot 6 months from now, But yeah, anyway, back to construction loans.
Sure. Just to pick up a little bit on a manufactured home versus a site-built home as it relates to some of these things. You could have a construction loan that could easily be 6 months, 9 months, 12 months. And yes, you don't pay for that whole amount during that time, but you also can't live in it during that time, right? And it's as that cost starts to build, then your payments get larger, right? As you start to spend money on the build. For a manufactured home, we don't pay for the house until it leaves the factory, and therefore you don't pay for the house, I should say, until it leaves the factory. And then between the time it leaves the factory and the time you can live in it is very short. I mean, potentially just conversationally 30 days. And so it all happens very quickly on the manufactured and the modular home side when you're dealing with a factory built home. So it's a huge advantage for several factors.
Mm-hmm.
The cost of a building loan is certainly one of those as well too. So let's try to pull Christian back into the conversation a little bit. Christian, on your side of it as well too, I know you had a program for single wides, but what can you tell us about what you're doing on on manufactured home on private land?
So we can do, singles and doubles are going to be very similar in terms of our financing. We can do a multi-section home on private property, even if they only want to do home only. Now, modulars they have to be tied to real property, but on a HUD product, we can do that home only or land home. One thing I wanted to add is that in our side of the industry, we do a lot of what we call land in lieu loans. So if you already own the land or your family's gifted you some land, depending on how recently you've purchased it and things like that, we have a lot of buyers that use their land in lieu of down payment. So what that means is, say your down payment was going to be, $10,000. If your land is worth $25,000, then a lot of times you don't have to come to closing with any money if that's your situation. Also on our side, what's more common, we used to do a lot of the two-time standard kind of traditional construction loans, two-time close, I should say. Now, most in the industry are doing either a one-time close or sometimes let's call it an end loan, where you don't really close until the loan or to the home is built. Most of the time, you're seeing this on like a spec property, like if you're building it and then selling it as a completed project. Most of the time, it's not, hey, like I'm looking for a home, and then you finance it at the end. Most of the time, those customers are going to be doing a one-time close on our side, where the construction interest is financed in. There are some lenders out there in our space that will allow you to, or will require, I should say, construction interest payments throughout the process. We don't do that. It's something that customers can do if they want to, in terms of they can bring that money to closing or pay it at the end. They can pay it once the loan modifies at the end and they move into the home. They can make that payment. If they want to pay towards that principal or interest, they're welcome to do that. But with the one-time close, it makes it a little bit less risky. Back in the day when I used to do some of the two-time, sometimes you see, something happens on somebody's credit, they lose their job. And when you have to reclose that second time, sometimes that can, everything has to be re-verified, income, credit, job, and everything like that. And so sometimes you pay a little bit more to do the one-time close, but you eliminate having to make those payments, and you eliminate some of that risk in terms of something, kind of life happening that might mess up your situation right before you get into your home.
Yeah, as we get into the one-time, two-time close, the traditional way to do it is a two-time close. You close on your construction dollars, and then you close on your long-term financing. But he's absolutely right. The one-time close in this market has gotten really, really big. There's just a lot more benefits as far as risk goes. If you do a one-time close, you close, and your home gets built, you move in. What happens if, like he was saying, if you lose your job on the in-between? Well, you've already closed. You've already qualified it. It's closed. You move in, you do your thing. Obviously, just make sure you make your payments, which is huge. I actually was talking to somebody a couple of days ago about the difference between one-time and two-time, and it was traditionally the one-time close, because you don't have to pay two sets of fees for title work and all that. And mind you, this is for a build on an actual property, not just a home-only loan. But typically the total costs on a one-time close, as far as those types of fees, are going to be less. So you're going to save a little bit of money. However, on a one-time close, the first thing you do is when you close, you've locked your interest rate. So that's going to be your interest rate for the entirety, right? So in a market a couple of years back when interest rates were going up, people wanted to lock right away. Now, The flip side is in a market right now where rates are supposed to be, we'll see what happens, supposed to be on the decline, maybe you don't want to do that. And maybe paying the extra fees for 2 closings is going to be worth it, because on your secondary loan, your long-term financing, you get a potentially better rate if the market continues to move in our favor. In anticipation for that, little plug for us, sorry guys, I don't know if you guys can do this too, but for our one-time close, we can actually renegotiate that rate at the time of when you move in, when the construction's done. When we do that, we'll essentially call it a loan modification. We'll modify your loan that you closed in a month ago or 2 months ago, or however long it take you to do your build. If rates have gotten better, we'll modify your loan to that better interest rate. So it's kind of a have your cake and eat it too type of situation. But obviously, that's advertising. Not everybody can qualify for a one-time close construction loan. You know what I mean? So it's really just get pre-approved first, get a plan together, and then let's move forward that way. And it might be, hey, 2 times better for you for this reason or that reason. It's just, you want to talk to one of us first so we can guide you down the right path.
It's never one size fits all, right?
Never.
So, and then on the modular side of things, that's typically being placed on a basement in this area. Sometimes a crawl space foundation would work, and then that is where it becomes part of real property without question. And that's also one of the things you'll find mostly in larger cities, that they're going to have zoning and requirements and rules and regulations, what have you, to have a basement. And so that is going to be closer to, probably as close to traditional mortgages as you can come for us coming out of our factories, right? It's still built in a factory, but it's treated by the banking world as similar as it were a site-built home. And so if you're in that situation, you're like, hey, let's just say I'm tired of paying rent. Rent's gone so high. I want to go down and talk to Adrenaline. I want to buy a home and I want to buy a lot there. What are some of the things that they should know in maybe particular on the down payment? What does somebody need to know on a down payment wise? And then I don't know, everything's different, but any comments on credit score, where you're hoping to be for the most preferred scenario, and maybe not the most preferred, but still qualifying scenario? Maybe give us some feedback on that.
Yeah, so I'll talk in the sense of like the construction, right? So our particular loan, everyone's going to be a little bit different. For the one that we offer, we can go up to 90% loan to value. So it goes into play whether you own that land already or not. If you're purchasing the land with the modular home, then it's all in one. That's your price, right? And we can lend 90% of that, meaning you put 10% down. If you already own the land, let's say you've owned some land for a long time and you're finally now deciding to purchase the modular home to put it on the land, we can actually use that land value as part of that down payment. So that's one option. Credit score, for our particular program, and again, everyone's different, but for our particular program, you would need a 680 minimum score to do the construction loan. It gets a little bit more restrictive the more risk involved. So let's say if you want to do just like 80%, which is kind of a traditional amount, then the 680 would be fine. If we do want to kind of push to that 90%, then you need a little bit of a higher score of a 720. But the kind of cool thing is there is no mortgage insurance. So typically people think that if I don't put my 20% down, then I'm going to be paying mortgage insurance, which mortgage insurance is something that protects the lender, does nothing for you as a buyer. So if you don't have to pay it, you don't necessarily want to have mortgage insurance. But that is a cool feature of our program, is that even though we don't have that necessarily 20% in there, there's no mortgage insurance in it.
Very cool. So again, it just depends on what type of loan product or program you qualify for. Ours are pretty standard, similarly to a purchase, right? So we'll do FHAs, we'll do VAs, conventional loans. FHAs go down to 580 credit score with a 3.5% down payment. Conventional is 5%, VA is 0%. There's a lot of different avenues, right? It's just, again, it's not one size fits all. So there's the reason why you got 3 lenders talking about similar types of things is because everybody's got a niche, and maybe one bank is better than another bank for this or that. And it's really just get pre-approved first, and then we can kind of help guide you in the right direction. I mean, I think it's cool. The 90% without mortgage insurance is super cool. If we do a traditional conventional loan, you're going to have mortgage insurance on it until you get to the 80% loan to value. You know what I mean? So everybody's got a niche, but generally speaking, you're just getting qualified and then guided to which way works best for you. But yeah, minimum down payments 3.5 for an FHA at a 580 score. Yeah, the challenge there is anything under a 580, even on a traditional forward mortgage, you got to have more skin in the game or less risk in order to offset that. So even on a forward mortgage, if you have like a 500 score, potentially you could get that done, but you have to have at least 10% down. And that's the federal government's requirement. That's not a you or a me thing. That's the Fed says this.
So then I just wanted to, because I'm assuming some of our audience might be first-time home buyers that don't even know some of this stuff. So a traditional mortgage, if you think of it that way, is 20% down. Is like, as long as I've been alive, it's been like the mentality, right? I got to save and get 20% down if I want to buy a house. But these other programs, the FHA, the VA, things like that, those are, the federal government has programs to help make home buying easier. And so they're going to essentially lessen the risk for the lender by getting involved. And so then that's how your down payment is made smaller down from that 20% to, in some odd cases, as low as 0%, right? Now, I bring that up just to help, but also once the federal government gets involved, sometimes there's some extra steps, some extra hoops, some extra requirements.
So
any thoughts on some of the sharing information about some of that?
Yeah, absolutely. So yes and no. The federal government has a minimum, right, that everybody has to follow if it's going to be a standard mortgage. Now there are ways to kind of go around that with like I believe they call it non-QM. So non-qualified mortgage, which means it's not technically backed by the federal government, which, it's essentially a bank saying, hey, we're going to lend you money. Traditionally speaking, like the Chattel loan, I think you were mentioning, has a slightly higher interest rate. I'm assuming it's because there's a higher layer of risk there. So in order to offset the risk, more interest, right? That's kind of standard across the board, whether it's a federally backed loan or a non-QM loan or this lender or that lender, wherever your risk factor is, the higher the risk, the more the cost to the consumer. The lower the risk, the less of a cost to a consumer. So we're talking about credit scores. If you have an 800 plus credit score, well, you pay your bills. There's not a lot of risk there. So you're going to get better terms overall. If you have a lower credit score, there's a little more risk there. You know what I mean? So it's going to require maybe bigger down payment or a higher interest rate or more cost or whatever the case is. You know what I mean? So again, I think I've said this 100 times now. Let's get pre-approved, and each individual situation is not one size fits all.
So when you get into more of the manufactured housing specific lenders, there's a little bit of a we go back to Chad. I like what you said about risk, because the reason that the risk is there is mainly because the home is not tied to the land. So what we're going to do is we're going to offer financing. Now, there are always limits, and those limits are going to vary by loan company. In our space, we're the most aggressive in terms of what we'll advance on a home-only loan, but we're not only going to loan for the home, but we're also going to loan for the delivery, the setup, the land prep, sometimes even like things like the well and the septic and land improvements, driveway, stuff like that. And so those are things that, if ever there were a situation where the bank had to foreclose, those are things that nobody would ever recover their money on. And so that's kind of the reason why that risk is higher. As we get back into the land home question, we will do on a non-FHA or VA loan, we'll do 5% down to 575 in a lot of cases. In our side of the industry, you generally do not see PMI or mortgage insurance on a non-FHA loan. So for us, you could potentially be 5% down to 575. On an FHA loan, you'd be like same as with everybody. Typically, it's 3.5% down. On a VA loan, it's 100% financing. So as long as the appraisal value is enough to cover everything, then those are typically zero down loans. I think a good thing to remember when you're looking at the difference between an FHA and a non-FHA loan is on a non-FHA or what a lot of people call conventional loans is it's based off of your credit score. So the better the credit score you have, the better the down payment you have, or some combination thereof, the better the interest rate's going to be. On most FHA and VA loans, you either qualify for the program or you don't. And when you qualify for it, you get the FHA rate. So the only thing that will typically change that rate in our space is the loan amount. So generally, so right now, if somebody were to finance, somewhere above like 225, 250,000, they're going to be somewhere in the fives. Whereas if that were to go down to, if they have their own land and they're purchasing, a single section home, which is totally doable, and say it's, 150, that those rates might be a point or two higher, depending on how the rates look at that time. Whereas on, so what you're going to typically see for FHA buyers is, you're going to have, if you have an 850 credit score or a 605, you're going to have the same interest rate. So typically, if you have someone who's an 805 and you look at, an 845, and they're looking at a conventional loan, the rate might be a little bit higher, but there's not going to be mortgage insurance in there. So a lot of people will go with a non-FHA loan if they've got excellent credit, because those FHA programs and the VA programs are more designed to help people that need a little bit of, assistance or a little bit of a leg up in terms of buying. So the higher qualified customers are generally going to gravitate more towards a non-government loan. Plus, there's a little bit less red tape. I mean, you know how it is. Anything where the government's involved, there's always a couple extra hoops to jump through. Yeah. And so, some people, gravitate towards the non-FHA whenever they can, just because the process is a little bit easier. But for a lot of buyers that are especially in the 600 to 675, 680 range, the FHA and VA loans are very advantageous.
Right. So I just have one last question, and then we'll have some closing comments. But the question I've heard a few times is, if I want to get pre-approved, I want to come in and looking at buying a house. Some people are afraid of checking their credit, by requesting a pre-approval from one place. That's one hit on their credit. And if they go to another place to compare, and then there's another hit, and it's not favorable to have multiple credit hits, for your credit score. But I believe, and I want to get some feedback from you. If you're shopping around all at one time, it's typically perceived as one hit on your credit score. Is there some comments on that? Is that true? Not true? Or should people shop around, or just select one of you and stick with one of you? What's the best approach?
Yeah, I mean, I always think it's good to shop around. While I think what you're saying does have some truth to it, I think if you have multiple inquiries on a credit by a mortgage company, it shouldn't count as multiple inquiries as far as like pulling down a credit score or anything like that. But I don't really think there's a reason for you to have multiple companies pull your credit. It's fine to shop, give them the scenario. They should be able to kind of give you an overview of how their program works and an idea of maybe what an interest rate is. They probably won't be able to give you a formal pre-approval, but it is definitely good to shop around and just kind of see what options are out there.
Yeah, absolutely. I believe it's 60 to 90 days from the original pull. And this is the credit bureau thing. It's not my realm, but I think it's 60 to 90 days from the original pull where you can have multiple mortgage inquiries and not have a decrease because of a high amount of inquiries. The whole inquiry thing, like, don't pull my credit, it's going to kill my scores. Well, if you're car shopping, you go to 3 different dealerships for 3 weekends in a row. Well, that's 9 pulls and each one's a hard hit, dropping your scores. That's where scores really go down. But too, a lot of companies, I don't know if you guys do this or the other entity here, Christian, right? it's not seeing you in person. It's hard. We do a soft pull. So we'll check out a soft pull. It's not a hard hit one way or another, just to kind of get you started and get a general idea. I like to do the soft pull rather than just a conversation piece. Hey, if I'm around here, because a lot of people don't know what's on their credit reports. So with a soft pull, I'm sure you guys do this too. We're going to go through it and say, hey, you got this, you got that, you got this. When we're qualifying somebody for a mortgage, no matter what program it is, we're going to essentially look at a debt to income ratio. And if you have a few credit cards maybe you forgot about, or you forgot that you co-signed for a car for somebody or something like that, we're going to see that and have a plan around it. If you co-signed for somebody a long time ago, not a big deal. Chances are it's going to be, we don't have to count it. But the stuff that's going to report is what we're going to look at. So I'd rather get a soft credit report in so we know a big picture and can be specific without it actually being a hard hit. You know, I tell clients that just call me asking questions. I'm like, hey, do an application. We'll do a soft credit pull. The application costs you $0. The credit pull is a soft credit pull, so it's not a hard hit. What's your risk? 20 minutes of time, maybe, if you're bad at computers, you know what I mean? And getting on the phone with me again to talk numbers. But that, you know, maybe 20 minutes is well worth the potential risk that you're putting yourself into not doing it. You know, if you do want to buy a house, rather take a couple minutes to do an app and get a good response rather than just flying by the seat of your pants. You know what I mean?
Especially if there's something fixable on there, right?
Yeah.
Sure.
I think you've actually had one client of ours who referred to you, and they're working through fixing something that was on there.
Absolutely.
So absolutely good step, good reminder on that.
Yeah.
Christian, anything to add on that?
Yeah, so you definitely, so I think it's good that there's pros and cons to shopping around, right? I think, that in our space, shopping around is a little bit more common because you never know how a particular buyer is going to hit somebody's sweet spot, So we in our space, we've got lenders that are going to use an average of your two scores. They might take your middle score. They may have an internal score, that company uses to kind of measure their own risk. There are some pros to kind of checking around to see who's going to give you the best offer, because sometimes you could be surprised. Sometimes you might get like a 2% interest rate difference between one bank in our space versus the other on a non-FHA loan that you wouldn't have had if you wouldn't have kind of shopped around a little bit. Now, my understanding of the law is that they changed it a few years ago. It used to be a 30-day window, and I believe now it's a 45-day window. So once you have your credit pulled once, it'll show as a hard inquiry, but it should not at least drag down your credit score by having that pulled. The downside, sometimes if you shop around too much, what we see pretty often on our side is like paralysis by analysis, right? Like there's times where if you give somebody, it's not like when you get, hey, this is choice A and choice B, and these are two simple options. I either want this or this. Each option is loaded with a lot of different things. One might have a better rate, but higher fees. One might, have an easier process, but the rate's a little higher. There's a lot that kind of goes into making the choice of the right lender. But I personally, would encourage anyone to shop around at least a little bit, not too much to where it's going to give you so much information that it's going to, scramble your brain. But I do think that there are some benefits into shopping around, because you never know. It's like he was saying a second ago, you're not going to lose anything by doing it. But sometimes you might get surprised by, hey, taking this one extra step, talking to one extra person, may be a significantly different payment for it.
Yeah, absolutely. It's that niche thing. Everybody's got a niche, and you might fit one person's mold better than another person's mold. I encourage shopping, but the paralysis by analysis, I like that a lot. I haven't heard that yet. I might steal that from you. It's very true though, because especially with a construction loan, there's so many moving parts between a build and disbursements and all the different things that you're trying to think of and try to remember. And this is our full-time job, is what we do every day. It's not what the average consumer does every day. So you're trying to understand all of that, but you have these different options within this company, but then you go to another company and try to understand that with all those different options. And if you get too many, it's going to be a whirlwind in your head. You're not going to be able to actually, see it on paper. Even if you're taking great notes, it's going to be a book of decisions to make.
Well, especially if we're dealing with first-time home buyers that never gone through this. We don't want to overwhelm them. We don't want to freak them out. Basically, our bottom line is call some of these folks and we'll talk it through, work it through, and let them worry about the difficulties involved.
Yeah, I think it's important to work with a good team, right? That's why kudos to you for bringing us all together and saying, okay, we know what these lenders can do, so let's put them all together. So work with a team that you trust.
Yeah, 100%.
All right, we do have a question from online, I believe.
Yes, Smug Hyperion 228 says, do I need 100% accurate pricing for general contracting to be pre-approved, or can I get approved with rough ballparks?
So generally speaking, it's always going to be rough until it's done. I mean, think about a general, you do your kitchen, right? The contractor might come in and say, hey, it's going to be this much. Well, it's not going to be exactly that much. So what I do personally, I'm sure you guys are similar too, is we're going to round up. We're going to say, hey, it's going to be this much. Let's round up a little bit to make sure that's safe. And there's also a reserve that's, well, a lot of times there's a reserve that's required too, just in case. Same.
Yeah, things always, unfortunately, tend to go a little bit higher than what you initially think. But yeah, that's a good point.
Yeah, generally, you want to be as dialed in as possible. And, in my first time talking, when I was talking about sometimes there's a range of how long things can take. Well, that's another variable that can go in there. Sometimes, you may have to get a couple bids from different contractors, a couple different, setup crews or like well and septic guys to make sure that you're getting the best price. And so typically all that is as ironed out as possible, but you never know. I mean, they may get out there to clear the land and start digging. I had one time in Ohio, they started digging in the ground and they found a car. It was a buried car, so that costs extra money. So, you never know what you're going to find once you get in. But you try your best because you don't want any unexpected surprises, and generally reclosing can be trickier than it might seem. On a home only, it's very easy, but once land is involved, it's trickier. But for the most part, your builder will do, Adrenaline Homes, is probably going to work with their contractors and their teams that they have in place to kind of get you the best possible, quotes that way, like, hey, this is what I'm in for as far as the best case and worst case, but you always got to have in your mind. And this is the same as if you're buying a site-built home or a manufactured home, or anytime you buy a home, there's always unknowns and there's always a risk that they're going to find something once they get in there that's going to be in excess of what was estimated.
Yeah, that brought up kind of a good point in what you were saying is when you do like the new construction type loan where they're going to build the house, it's very important that you don't start any of that work ahead of time. And you might think it's something simple like even, I'm going to go clear the trees. A lot of lenders may not lend to do a construction loan after that if you've already started some work. It's called like a pre-start. So make sure you get the financing in play first, close on your loan, and then the construction can start. But don't do anything before your loan.
All right, good advice. So for us at Adrenaline Homes, we love the fact that our houses are coming out of a factory. The timeline is very reliable for the house portion of it. And also those variables and cost overruns and things like that are not involved in the house, just the outside general contracted fees. So we're trying to lock down as many as we can. So there's still variables, but a lot fewer than a site-built home. We think that. So I want to give each of you an opportunity going around. I'll start with you, Michelle, and maybe just here's your opportunity to kind of give us a commercial about why working with you and what you do. And don't be shameful. Just let us know.
Awesome. Well, thanks for the opportunity today. This has been fun. I am certified to do the new construction lending, so I do like to do that. Something aside of kind of the new construction piece, something that I do specialize in is divorce lending. So I help a lot of homeowners that are going through a divorce, understanding what their options are after the divorce is final. So if anyone kind of falls into that category and you want to give me a call for advice, I'd be happy to help with that. But yeah, thanks again for the opportunity today.
Yeah, thank you. Yeah, we do. So many different things. This manufactured home thing is something that we've been really proud over these past couple of years, being able to offer a lot of different options to people like that. But anything residential. We actually do have some commercial outlets, but my niche is really anything residential, whether you're building a new, buying an existing, renovating, doing a reno loan or a refi or whatever. Anything in that realm is really, really my focus. Yeah, as far as, what is it called, an elevator pitch? Is that what they call it, right? Call me because I'm very talkative. I don't know. I used to be a teacher, so I really like to educate more than like tell people what to do. I'll teach you how it works and the why, and then kind of let you make your own decisions. That's my thing. And the other thing I tell the clients all the time, I used to teach 6th grade. So there's no dumb questions. Trust me. Ask me anything and ask me everything. I would love the opportunity to educate people on their options.
All right, Christian, how about you?
Yeah, well, thank you so much for having me again. This has been great. In terms of, manufactured housing, we are about as close to a one-stop shop as you get. We're one of the only companies that does everything from the home only through the agency loans. Most lenders in our space will either do, if they do home only, they're not going to offer any agency loans, the FHA, VA loans, or vice versa. So we're one of the few that actually does all of that. We were the ones that basically in the late 90s kind of figured out how to adapt FHA Title II loans to the manufactured housing space. And so we operate at a very clean, high level. We've never had to change our names. We've never been in legal trouble or anything like that. And we take a lot of pride in doing things the right way and doing things in a way that protects the buyer and the builder. If you have any inkling and you want to apply, you can do so through Adrenaline Homes, or you can go to cascadeloans.com. That's loans with an S. We'd love the opportunity to work with you. And if there's anything that you need, my name is Christian Blaker. I can be reached at christian.blaker@cascadeloans.com.
Yeah, we'll have posted on our website contact information for all of you shortly after this wraps up, and as well as this will be able to be replayed right off our website as well too. So thank you all very much for taking your time today. Appreciate it. It's a lot of great information, and I think we've done exactly what we were set out to do. So thank you.
Great.
Appreciate
awesome.
it. Thank you.
Thanks, guys.